สวัสดีครับต้อนรับเข้าสู่รายการพิเศษ FINNOMENA X Franklin Templeton การจับมือครั้งสำคัญที่จะรวบรวมข้อมูลด้านการลงทุนระดับโลกนะครับมาแชร์ให้กับนักลงทุนชาวไทยได้ฟังกันวันนี้พบกับผมทัชพล ปาละบรรจง Portfolio Specialist ของ FINNOMENA ครับในปีที่แล้วเนี่ยเราเจอกับวิกฤตโควิด -19 นะครับที่ทำให้เศรษฐกิจทั่วโลกเนี่ยมันมีการชะงักตัวลงไปนะครับแต่ว่าด้วยการมาของวัคซีนเนี่ยมันทำให้เศรษฐกิจเนี่ยเริ่มจะกลับมาเรื่อยๆนะครับดังนั้นเนี่ยวันนี้นะครับผมได้เชิญผู้เชี่ยวชาญนะครับด้านการลงทุนจาก Franklin Templeton ที่จะมาพูดคุยนะครับเกี่ยวกับมุมมองการลงทุนหลังจากโควิดนะครับผมวันนี้พบกับคุณ Ajay Dayal นะครับจาก Franklin Templeton ครับ Hi Ajay.
Hello, Paul.
Yeah, thank you for joining us for sharing the global market outlook after the pandemic. But first of all, before we go into the topic, can you please introduce yourselves?
I can, thank you. My name is Ajay Dayal. I'm an investment director at Franklin Templeton. I work within the Global Investment Strategic Group, and our role is very much to provide insights, perspectives on a number of our investment specialties and managers that we have within the Franklin Templeton business. I have over 20 years of investment experience working in the industry, and I first started my career working out in Asia, in Hong Kong, and came back, and I live now in London, where I've been living for nearly over 15 years.
Okay. As we have been through the global pandemic, the situation right now is getting better and better. But however, we have seen that over the past 2 or 3 weeks ago, we see the market has been corrected. Could you share us about the global market situations?
I'd be delighted to. So let me use my presentation and run through the key perspectives on how we look at the world today, how the world is changing, and how there are opportunities for equity investors, but also bond investors, and what are the opportunities and where are those opportunities in the world that we think today. So let me progress. So first of all, how do we look at the world? What is our kind of broad market outlook? And the first thing to say is it's that there are key drivers to the world today. One is the impact from the COVID pandemic and how we recover back to a new normal. And then looking at the world from, how have governments responded in the meantime, and how are they likely to respond and continue to be supportive in the future? And we believe they'll do so with lower interest rates for longer periods of time. And governments are also going to stimulate economies by driving economic growth, by creating new infrastructure, by effectively pushing money into the system. We believe in this environment, equities are likely to outperform long term. They may have periods where they go down for short periods, but we think that equities in this period where risk assets are more elevated and attractive, we actually think that equities will be a long-term positive opportunity. And where we see those opportunities are in the global markets, not just the US. And we also see them within the value markets. When we say value, we mean things that are economically sensitive and cyclical. They're based on the nature of the economy, the growth of the economy, the growth of spending from consumers and businesses is going to lead to certain types of value companies. Think about manufacturing companies, think about chemical companies, think about plastic makers, think about energy businesses, banks, consumer goods businesses which are making machines. These are part of the kind of more value perspective. And we also think there's going to be a really strong opportunity within income investments as well. And the reason for that is interest rates in the world are so low. In the US, bank interest rates are nearly 0.25. In the UK, they're about the same number. Even if you look at Thailand, effectively the base rate, the bank base rate from the Thai government is about 0.5%. The 10-year yield in Thailand today is roughly 1.7%. In the US, nearly 1.6%. These are incredibly low bond yields and interest rates in the world. So people are desperate for income, and where are they going to find it? And I think income stocks, equities that pay good income, emerging markets, high yield debt that pays good income, sustainable income, is going to be an attractive area. So let me progress and show you what I think is some really interesting perspectives on why the world is changing and why we should be positive, but also recognize it's not going to be a smooth journey. That's the important thing, right? There will be bumps in the road. So first thing, COVID vaccinations, right? That's the COVID vaccinations are happening all over the world. So for example, in the UK where I live, over 90% of the population that is over the age of 60 has now been vaccinated. We have had 20 million people vaccinated with at least one injection in the UK, and our population is close to 70 million people. So we are quickly tackling the most vulnerable people, the older people in society. We know that we're much ahead of places in Europe, places in Asia. If you look at the US, 50% of people above the age of 65 are vaccinated. 1 in 15, right, are in the younger age groups have now been vaccinated. So we're seeing a build-up. But however, these are some countries. What we need is more countries around the world to have stronger vaccination campaigns. So that's why on my left of my screen here, what you can see is vaccines or vaccinations. Vaccines are what you actually get in, the shot, the jab. But there are many vaccines that are being created now, which is great. And the more vaccines that are created, the Pfizer one, the AstraZeneca one, the ones from China, the ones from Russia, the more of these vaccines that are in the world today, the faster the global population can get vaccinated, right? And the vaccination program takes time. And there are going to be some countries in the world which are slower. Even in Europe today, there are many places within Europe which are extremely slow in their vaccination program for different reasons, political reasons, slow healthcare transitions. And it's a really interesting period. So interesting from the perspective that the world will not just go back to normal tomorrow. It will take a long time for it to adjust. And that's what we have to be cautious about. The pace of recovery, the breadth of recovery, i.e. how many countries will benefit, is all going to be very different. And that's going to lead to anxiety at times. That's going to lead to economic negativity at times when certain markets have maybe reissues of COVID. They may have to shut down their economies again. And this may lead to an economic scare for selective countries, selective regions. So these are all things to bear in mind. But have we got reason to be positive? Yes. The vaccines that have been developed are some of the fastest vaccines in history to have been created post the pandemic. So the research, the technology, the medical advancement that we've created over the last 20 years, especially using kind of biodata, has led to enormous changes in the speed of vaccines. And that is what we're seeing in the world today. So how do I show positivity? How do I show some level of economic improvement? And if you look here on this chart, you can see that housing starts and house buildings in the US were very, very high. And this is a chart for nearly 16 years from 2004. And you can see that housing starts have increased dramatically over this period of time. So housing starts are the number of new houses that are created on a monthly basis in the US. And when people feel positive, they start to put down their deposits for new houses, and the housing starts in the US has increased. So this is a really good indicator that positivity and the wealth effect is coming back in different parts of the world. If you look at this chart, you can see that what we have here is a chart showing massive fiscal stimulus. What this is trying to show you is how much stimulus is being injected into the global economy. And I think, many people might think, well, we know that the different banks, the central banks around the world People's Bank of China, the ECB in Europe, the Bank of Japan, the Bank of England, the Federal Reserve in the US, and a number of other central banks in the world, they've all been very accommodative. They've spent enormous sums of money putting more liquidity into the system, buying bonds, so creating liquidity into the marketplace. But I think it's only when you look at a chart like this that you realize how much central banks have invested. They invested a lot during the financial crisis, 2008, 2009. You can see me here, hopefully showing it as. But look at the change in 2020, and we expect that to continue in 2021. Enormous amounts of effectively monetary spending, but monetary stimulus. But there's also been fiscal spending. Governments around the world have been spending more money. Look at the US more recently. They have agreed a $1.9 trillion fiscal stimulus, giving checks to people. Over $1,000 checks they're sending to every person, every adult in the US. So this is an amazing way of putting money into people's hands, getting them out there spending again. They've also given very good support to the unemployed, and in different parts of the world, they've been able to be supportive. Now, we know the Western governments have been able to do that a little bit better, but unfortunately, not all over the world. In Africa, there are many countries which are suffering. In Asia, there are many countries that are suffering from reduced economic activity. However, with strong economic growth starting to come back, that's going to benefit the world, and that's going to generate demand. So if we go to this slide, you can see corporations. This is about the amount of debt that corporations have on their balance sheet, right? And corporations, right, have actually increased debt over time, but it's not to the extent that it's so aggressive that we should be concerned. If you look at debt here in 2018, 2020, corporate debt levels have increased, but not dramatically. Emerging market debt, the orange line, right? The lower debt in local currency, it's not been too aggressive. Overall, I would say that emerging market corporations have about 120 to 125% of the total GDP in corporate debt. So corporate debt hasn't increased aggressively, which means balance sheets are still, well looked after within most parts of the world. Now, then you might say, well, we see that the world economy is growing, but are we seeing that the companies themselves are making more money? Are we seeing that corporations are likely to make more money, right? And so how do we look at this? And I think this is a really fantastic chart. It shows you two things: how much the earnings of companies reduced to in 2020, that is the blue bar, and how much they are likely to be increasing by in 2021, the green bar. And this number, the 100% number, is 2019 numbers. So if we look at China, for example, in 2020, most companies made up really nearly 98% of their earnings compared to 2019. So only a small drop. And they're likely to be increasing their earnings by a significant amount in 2021. They're going to be almost 12% higher than they were in 2019. Look at Europe. If you look at Europe emerging markets ex-China. Outside of China, the rest of emerging markets in Latin America, in Eastern Europe, in Asia, their earnings came down dramatically, 84%. So they lost almost 16% compared to 2019. However, they're going to rebound really strongly, we believe, in 2021. They're going to increase to 116%. So a big 16% increase. So we're seeing a lot of companies, yes, they had a bad 2020, but they're going to make it all up and in 2021, right? Countries which may not, maybe countries like Japan, even look at the UK where I'm based. We're expecting a significant bounce back in the economy this calendar year. And the US, as you can see, being the world's largest economy, has gone from reducing a little bit in 2020 So rebounding strongly. Expectations are now that the US economy will grow by at least 5% in 2021. That's an enormous growth rate for the world's largest economy. So you might be then saying, so are we starting to see potentially inflation in certain areas? And is that going to affect bond rates? Well, if you look at US 10-year bond, the US 10-year bond is nearly 1.58 today. It says 1.48, but in the last 2 weeks, it's increased again. So the bond markets are, if the yield goes up, it is reflecting to a certain extent that there may be some inflation coming in the world in the future because the world is reflating, i.e. growing. So the bond markets are reflecting to a certain extent that the world's going to get slightly better. If bond yields came down, it would be saying we're nervous. We're not sure what's going to happen in the future. So then you might say, well, okay, I know the equity market since last April, March, April 2020, they have been going at a frightening speed uphill. They've been incredibly strong, especially in Asia, especially in China, in the US. China's been an incredibly strong market. So we've seen these incredibly strong growth rates in the equity markets. And some people are saying, is it too expensive? Has it become too expensive? Now, what this chart is showing you is the cyclically adjusted PE ratio, what we call the CAPE, C-A-P-E, and of the S&P. And the cyclically adjusted PE ratio, which is the price of companies divided by their earnings of companies, is nearly 33 times today. So it's not cheap on a long-term basis compared to, let's say, the last 20 years. However, the last time, but it has been higher. In the technology boom of 1999 to 2000, it was much higher. However, how can we give confidence that we still think that equities, even in the US market, can offer value? And one way to look at that is looking at effectively looking at corporate bond yields. If we look at corporate bond yields, they're about 3% today on, let's say, a BAA, a kind of investment grade bond. If you look at that and you then say to yourself, what would be the implied level of PE on a corporate bond if you could work out the PE of a corporate bond? And that roughly works out at about 32. So what we're saying is today, although equity markets, especially in the US, look a little bit more expensive than history, they're still relatively well priced compared to what bond markets are offering in terms of their yields. Now, what is exciting is the way that the currency market may help the global market. A strong US dollar often means a kind of weaker emerging markets in Asia. And one of the things that Thai investors, especially, and people running businesses in Thailand, may be positive and hopeful for is a weaker dollar. A weaker dollar supports more trade and activity around the world, right? A strong dollar obviously helps exports. Effectively, the Americans can buy emerging market goods cheaper. But in terms of supporting international stocks, a weaker dollar helps historically. So as you can see in this chart, the blue line shows you the strength of the US dollar, and the green line shows you which markets do well when the US dollar is declining in strength. And if you look at more recently, as the US dollar has declined in strength, it's gone down, right? You can see that in the recent period. What's happened to the green line? The green line has effectively, which is the MSCI World ex-US. It's saying, how has the rest of the world's equity markets performed? A strong dollar often leads to a weak international equity markets, but a weak US dollar often leads to stronger international equity markets. And that's a good thing. And if that happens, then we're going to see more opportunities outside of the US, more opportunities for international stocks to do well emerging markets, Europe, Asia. And I think, that's really interesting. Moving on to a couple more positive aspects, but also looking at some of the risks. One of the risks, and again, this information is particularly about the US, but I think the US being the world's largest economy, it's useful to see some of these statistics. The US labor market, since having nearly 20 million people unemployed, 21 million in April 2020, after the pandemic first hit, it's been increasing its monthly number of employment in the US from 2.7 to 4.8 million people per month. However, the numbers of people being employed is falling. The labor market is improving, but it's declining. Now, people are wondering why. Now, I think a part of that is there are many people already in full-time employment who have just stayed at home. So companies don't need more employees right now because they're just expecting their current workers to go back in. But what we're going to see is when those businesses actually start and continue to grow, we expect that labor to start to increase, more demand. But right now we're at that kind of gentle point where businesses are really not hiring that many more people until they see economic activity start to rise more sharply. Now, you might say, well, Ajay, you mentioned right at the beginning that the governments are spending money, right? And they have been spending money. They've been giving effectively checks. They've been giving welfare support. They've been investing in people. But what does this mean? And how does this help people? And how do we see this, the spending also changing? Is it just checks to people? And the answer is no. They're also making dramatic investments for the long term in infrastructure. Around the world, more and more governments are talking about the Green Deal. How do they transform their economies from being carbon intensive to decarbonizing, using less coal, oil, and gas? They want to decarbonize their societies. Why? Because they know that burning of carbon leads to greenhouse gases, leads to a warming up of the global environment. And many nations around the world have agreed to try to keep the growth of temperature to less than 1.5 degrees. So to do that, especially with growing populations, they need to transform their economies. And they need to do so, number one, by changing how we get energy. So when we receive electricity in our homes, a lot of that electricity is created by burning oil, coal, or gas. And so what we're going to see is more renewable companies being developed, wind farms, solar farms. This is going to be a way of moving away from old carbon burning. So wind farms, solar farms, and the use of hydrogen, which is clean hydrogen, green hydrogen, that's going to replace some of these older fuels. It will take a long time. But what we're seeing here, the chart on the left-hand side shows you the growth in renewables. Renewables being wind farms, solar farms, hydro. And you can see we expect the growth per year up to 2040. So for the next 20 years, we expect the investments in energy finance for renewables to be growing at nearly 8% per year for the next 20 years. Enormous sums of money. Joe Biden wants to commit over $1 trillion to making the water system better in the US, the electricity system better in the US, the pipeline system better in the US. Why? Because they need to. And many governments in the world are doing the same thing. The European Union has got the new Green Deal. They're trying to invest in better utility companies, cleaner utility companies. It's happening all over the world. And so we're going to see enormous sums of money. For example, just in electricity supply and delivery to people, we're going to see over $20 trillion, we believe, in the next 20 years. And we think that number is too low. We actually think the real number will be more than double that because governments around the world are moving faster now. So finishing off, there is a good reason to be positive. First reason is the COVID recovery. We have vaccines. We have created vaccines very quickly in the big scheme of things, and the world now is benefiting from that through the vaccination campaigns, but it takes time. Some countries are faster than others, and countries will not trade with each other or let people transfer and travel to other countries until they know they're secure. So the pace of recovery will be dependent on how quickly vaccinations can get rolled out around the world. So there will be stop and starts. There will be slow progress in some countries, faster in others. However, governments and central banks are doing whatever they can to make this economy, make the global economy stimulated. They are supporting the global economy, and they're doing so through monetary and fiscal stimulus. All major regions of the world should benefit from this, right? And it's great that we have these low interest rates, and it's going to be positive for risky assets because people are desperate to earn more money from their investments. They're also going to need more money for income, from income perspectives. We believe in this environment, equity is likely to outperform. The recovery, the earnings recovery is happening. Corporations are already making more money. We think the multiples for equities is relatively still even. They're not too expensive compared to the long-term growth, right? Yes, earnings, like let's say the PE of, let's say, some of the US stocks, especially the technology stocks, seems very expensive. However, there's a great part of the US equity market and global equity market that does not benefit as much. And so the value-based companies we think are going to be winners. We also think opportunistically bond funds, can also benefit. Bond funds that are smart in how they allocate into good yielding assets, maybe benefiting also from exchange rate movements and currency movements. So we're looking for flexible bond funds we think will be very good, and in emerging markets and high yield bonds can offer a good, attractive and sustainable yield more than, let's say, the US 10-year government bonds, but selectivity is key. Final, opportunities. We see opportunities all over the world. The value market has been incredibly cheap for many, many years. And we think there's going to be more investing in value type stocks. Think energy, materials, engineering companies, old-fashioned consumer companies. We think there's going to be a growth in many of these companies in the world over the next few years. The weak dollar is good for international stocks. Infrastructure is going to be a key driver for the world. And we think that's going to lead to not just money today, but money that creates jobs. And the more jobs that are created, the more wealth that goes back into the system, and the wealthier populations become around the world. That's such a key thing. The infrastructure outlook is incredibly important. We see Japanese corporations also doing well. They're becoming healthier. And the reason we mention Japanese corporations is because for many, many years, people have not been interested to invest in Japan, but because Japan is very much a value or economically sensitive nation, and we're starting to see economic growth improve in Japan, and many of those export companies that Japan is known for start to grow, start to make higher earnings. We think this is a big positive thing also for emerging markets. Emerging markets took a very big hit in 2020, but we think going forward, they're going to start recovering slowly but surely, and they're going to benefit from the global economic recovery.
และนี่เป็นการพูดคุยเกี่ยวกับมุมมองด้านการลงทุนนะครับหลังจากโรคโควิด -19 นะครับผมโดยคุณ Ajay Dayal จาก Franklin Templeton สำหรับนักลงทุนที่สนใจรายละเอียดเกี่ยวกับด้านการลงทุนระดับโลกนะครับสามารถติดตามได้ใน FINNOMENA.com/Franklin Templeton วันนี้ผมทัชพล ปาละบรรจง Portfolio Specialist ของ FINNOMENA และทีมงานขอลาไปก่อนครับสวัสดีครับ